What if you could retire as soon as you reach your minimum retirement age, even if you only have 10 years of federal service? For many federal employees, this is possible under the MRA+10 retirement provision. But before you start planning your early exit, it's important to understand both the advantages and the drawbacks of this option, because the decision you make could impact your pension for the rest of your life. Let's break down exactly how MRA+10 works, who it's for, and what you need to consider before making your move. First, a quick refresher. Your minimum retirement age, or MRA, is the earliest age you can retire under the Federal Employees Retirement System, or FERS. Depending on your birth year, your MRA falls somewhere between 55 and 57. Normally, to retire with an immediate, unreduced pension, you'd need to reach your MRA with at least 30 years of service, or be age 60 with 20 years, or age 62 with at least 5 years. But what if you don't have that much service? That's where MRA+10 comes in. If you've reached your MRA and have at least 10 years of creditable federal service, you can choose to retire under this provision. It gives you the flexibility to leave federal service earlier than the standard rules allow. Sounds appealing, right? But here's the catch. If you retire under MRA+10 and start your pension right away, your monthly benefit will be permanently reduced. The reduction is 5% for every year you are under age 62 when you begin your pension. For example, if you retire at age 57, that's 5 years before 62, so your pension would be cut by 25% for life. If your unreduced pension would have been $20,000 a year, you'd only receive $15,000 a year, and that reduction never goes away, even after you turn 62. Is there a way to avoid this penalty? Yes. You can retire under MRA+10, but instead of starting your pension right away, you can postpone it until age 62, or age 60 if you have at least 20 years of service. This is called a deferred pension. By waiting, you avoid the reduction entirely, but you won't receive any pension payments during those years. You'll need to rely on other sources of income, like your thrift savings plan or outside employment, until your pension begins. There are some additional benefits to consider. If you postpone your pension instead of deferring it completely, you may be able to keep your eligibility for federal health and life insurance in retirement. This can be a major advantage for those who want to leave federal service but still want to maintain their benefits. On the downside, retiring under MRA+10 means you won't qualify for the Special Retirement Supplement, which is designed to bridge the gap between your retirement and when you become eligible for Social Security. You may also need to dip into your TSP or other savings to cover expenses until your pension starts. Let's look at a quick example. Suppose you're 57 with 15 years of service. If you retire now and take your pension immediately, you'll face a 25% reduction. So a $12,000 pension becomes $9,000 a year for life. If you leave federal service at 57 but wait until 62 to start your pension, you'll get the full $12,000. But you'll need to cover 5 years without a pension check. In summary, MRA+10 retirement offers flexibility for those who need or want to leave federal service early. But the trade-off is a significant and permanent reduction in your pension unless you postpone your benefit. Carefully weigh your financial situation, your need for health insurance, and your other sources of income before making this decision. If you found this breakdown helpful, be sure to like and subscribe, and visit federalpensionadvisor.com for more tips and resources to help you plan your federal retirement. In our next video, we'll cover the FERS Special Retirement Supplement and how it can help bridge the gap before Social Security.